Hello guys, welcome back again to MJ Crypto, and this video is specially made for all the newbies out there, the beginners who want to step into the crypto space and they actually want to trade futures. All right, so if you're a newbie or a beginner, or you're an existing trader and you just do not understand some key terms on futures trading, this video is actually for you. So sit back, relax yourself, take a good just have a good time while you watch this video, and ensure you watch it to the very end. All right, so the very first thing as a crypto trader that you want to understand on futures trading is to know what exactly the concept of futures trading is. Futures trading is simply a contract whereby you as a trader go into with an exchange. All right, good. It is totally different from your normal spot trading. All right, your normal spot trading, you have access to the funds because you are buying them and storing them of what their intrinsic value. Okay, you own and retain the value of that asset. It's not a contract, but futures is a perpetual contract between yourself and the exchange, which is Binance or any other exchange out there. All right, now having understood these fundamentals, you can now see that it is risky. All right, it is risky, but if you understand what risk management is, which we'll also talk about in the course of this video, futures trading will be very superb and interesting for you. So now let's go over to the very first step, and that is step one. Step one, how do you engage on futures trading? The first thing you need to do is to have some money in your portfolio on futures. So to actually do that, you come over to wallets, you go to transfer, and then you transfer your funds from spot wallets to your futures account. So you just simply go here and type USDM futures. So you can see you are transferring from spot wallet to USDM futures, and you just click on the coin you actually want to be trading with, which is most times it is USDT. Click on USDT and you select how much it is you want to transfer. So right here, I'll be making a transfer of just $50 for the course of this video, and we'll be entering a live trade with this amount. All right. So let's click on confirm transfer. Now we've done that, and we're going to head over to futures itself and see our funds. So you can see right here we have 50 USDT to play around with. All right, good. Now, this is the interface of the futures section, and I'm just going to walk you through everything you see here so that you understand it clearly. All right, it's very interesting, and it's something you would actually want to do all the time. It's addictive, so you need to understand it before you venture into it. So right here on the top left, you can see isolated. You can see isolated. If you click on isolated right here, it will tell you margin mode, which is cross and isolated. Now, the margin itself is the amount you have that you want to that you want to use to serve as your collateral for a trade. Okay, let's say for example, you have $1,000 in your account and you want to go into a trade. That trade, because futures is a perpetual contract, that $1,000 will be serving as your collateral. So margin itself serves as a collateral to service your leverage. We'll be talking about that in the course of this video, so you don't get confused. All right, good. So we have two types of margin modes. We have the cross margin, and of course we have the isolated margin. Now for the cross margin, the margin which is serving as your collateral can help you manage all the positions you enter on a trade. Now, let's say we enter a particular, let's say we go into a trade and we have multiple positions. Let's say we take 3 positions on 3 different coins. Let's say TRX USDT, Matic USDT, BNB USDT. Now we're trading these 3 assets differently, and we have a margin of $1,000 in our portfolio. That $1,000 will serve as a purpose of collateral to maintain the risk associated with trading those three pairs differently. All right, that is why it's called cross margin. All right, it will serve as your portfolio. Let's say, for example, you go into the bank, or let's say you want to take a loan, for example. I'm giving you a real life example right now. You go into borrowing and you want to take loans from three different banks, and you have just one property serving as a collateral. All right. Now you want to use that one property to take loans from three different banks. So that is what the margin is serving as right now. It's serving as your what collateral, because you are leveraging on what three different banks now to take a loan from. All right. So basically, that is what the margin is all about. Now, for the isolated margin, what that means is that every position you go into, let's say you are trading BNB against USDT, you are trading TRX against USDT, and you are trading Ethereum against USDT, you are opening three positions here on Binance. Don't worry, we'll practicalize all these things so that you understand them clearly. What this is that every position you take is going to strictly be what? Serviced by the amount you are using to enter that trade. It is no longer tied. It is no longer crossed to your margin. It will now be isolated. Now, let's say, for instance, ETH USDT, you are using $10. BNB USDT, you are using $10. And TRX USDT, you are using $10. So you are risking just $30 of your portfolio, unlike cross margin, whereby your entire $50 that we have right now will be risked. All right, good. So let's go, guys. We're going to practicalize everything we say in this video, and this is actually the video you need to begin your journey into futures trading. So the next thing we want to talk about is the leverage. Okay, you can see right here we have 20x. Just click on this. You can see 20x. 20x, this is what we call leverage. Now, leverage is the amount you want the exchange to borrow you. Now, let's say if we have $50 in this account, just as we have right now, and you want Binance to borrow you, or rather to lend you times 20 of this amount. So times 20 of 50 is going to be what? $1,000. So you want your entire position to be $1,000. You can go as far as even borrowing what do you call it, 550x, okay, times your what? Initial capital. Okay, you can borrow as high as 50x, but that is very risky. I would explain that in the course of this video. So now let's go back. That is leverage. Leverage is simply how much you want to what? Borrow. So if you have 1 million, you want to borrow times 20, you'll be having 20 million. So just simple as that. So right here we have limits. These are types of orders. Limit order, we have post only, we have market, we have stop limit, we have stop market, trailing stop, and TWAP. Okay. Good. Now, but most commonly you'll be using the stop, you'll be using the limit and market orders, all right, just to place a trade. Now, the limit order is when you actually want to place a trade, not at the current market price. Let's say, for example, Matic USDT, we're actually on this pair right now. I want to buy this asset not at the current market price. The current market price is 0.5154. You can see right here. Watch my mouse. 0.5150 is fluctuating. This is the current market price. All right. But let's say you want the price to go lower. So you can select limit and then put the actual price you want it to go down to. If you want it to go down to 0.05000, you can just put the limit there and then scroll your cursor to how much percent you actually want to use to purchase this asset. All right, beautiful. And then you just click on buy. All right, we'll be talking about that very soon. And then the market section is when you want to buy an asset at the current market price. All right, you want to just go into the market. You don't want the price to be lower. You just want to buy the way it is. Okay, so you can do that. Drag your cursor to how much it is you want to purchase, and then you're on your way up already. The trade will ignite. Now, there's what we call the stop loss and take profit. Now, to actually go on futures trading is a journey, okay, and you need to be guided properly. There's what we call the stop loss, and of course the take profit. Now, what is the stop loss? Good, you can see right here, I just clicked on it, TP/SL. You can see it, TP/SL. This is actually where you go to put your take profit and to put your stop loss. All right, good. So once you click on that, you can easily just put the price you want to what, take your profit on, and the price you actually want to what, take your stop loss. Now, the take profit is the price the asset will go to for you to secure your profit, and the stop loss is your only savior right here. Is the price the asset will go to what, prevent you from going further in losses. All right, whether it is you are buying or you are selling. All right, and there's what we call the buy and sell. The buy means to long, and the sell means to short. Now, for futures trading, you can make money by buying, and you can also make money by selling. Now, I would show you a live example right about now while going into the practical section right now. We'll be taking a buy position, and of course, we'll be taking a sell position on the different margin modes. So now let's roll, guys. Practical time. So guys, for the practical section, this is Matic USDT, and we will be making a trade right now using the buy, which is long, and we'll be doing just 5x. Okay, we'll be doing just 5x. Now, when you are trading or you are new to futures, don't go above 5x, because anything above 5x, it's kind of a little bit more exposed to your margin, and you can get liquidated easily. All right, so I'm just going to set this at isolated, so I would explain so we can actually see what I've been talking about. This is isolated right now, and I'm buying at limit price first. Buying at limit price. I'm waiting for the price to go to 0.51, 0.5, let's say 500, and then I'm buying with, how much of my portfolio am I buying with? That's why I'm dragging this cursor. All right, so I want to buy with 10% of my portfolio, and then I want to put my take profit to let's say 0.5200. So in other words, I'm saying that should the price of these assets go down to 0.5000, which is this, please Binance, initiate an order for me. Buy this asset for me. I want to trade. That's what I'm saying. It's an order. Okay, so that's why it will show here as open orders. You will see it right now when we ignite this trade. Okay, and I'll put my stop loss, let's say at 0.4900. So my stop loss will just be there, right? Good. So I'll just click on buy long, and you see this trade will ignite and show right here as an open order. Remember, this is isolated. Okay, we're on isolated, we are not on cross. So if I'm risking just 10% of my account, how much am I risking? I'm risking just 10%, using just 10% to trade, which is 5 USDT. You can see right here. If I should hit a liquidation, I'll be losing just 5 USDT. In other words, if this trade goes against me, I'll be losing just 5 USDT. So I'll click on buy long and just click on that. And you can see it's actually active on open orders. The trade has not started because I'm on limit order. So when the price gets to that amount I set, which was 0.50000, this trade will ignite and it will start showing on positions. All right, so basically this is how to trade using the limit, and of course you can see here we're on isolated. So now let's cancel this. Let's just cancel this, and Let's take another position right here, the same way we did this on Matic USDT, and let's use the cross margin. All right, now let's use cross. Now if I click on cross, the same way I did it for isolated just now, I'll just simply go here again, put the amount of my portfolio which I'm trading with to enter this position, and I'll put my take profit, let's say 0.5100, and my stop loss 0.4900, and then I click on what? Buy long. Good. So you can see right here we have success, but this trade is actually on what? Cross. All right, this trade is actually on what? Cross. It's not on isolated. All right, beautiful. So I would cancel this, and then we still have our 50 USDT back intact. So basically this is just how to go into a trade. All right, it's simple and very, very straightforward. All right, guys, what next do I need to tell you? Now for the isolated section, when we're actually trading and want to go into a live trade, we'll do that right now. You don't have to put it on, you can go into a trade either by limit or market. So if you want to go into the market and buy at the current market price, you can just change it here from limits and put it on market. Now let's go back to isolated and put that on isolated. Good. So you can see right here, our leverage is still 5x. So don't forget we're buying. So you can see right here, let's say I'm using 10% of this account and I'm buying at current market price, and I want to put this take profit at 0.5200, and I'll put my stop loss somewhere at 0.5100. The stop loss has to be below the current market price. This is the current market price right here. All right, good. So I'll just do that and then click on buy long. You see it will show on positions. Oh, sorry, this is actually too close. Let me reduce this a little so you see for yourself. Let's see 0.4900, and then we just click on buy long, and boom. Good. So you can see right here we have our position. The trade is running. Trade is currently on. This is just to test and see how it works. All right, basically. And now under these positions right here, you can see we have the size of the USDT. We have the margin. We have the margin right here. You can adjust your margin if you want to. You can add some margin to it, but this is mostly used when you're on cross. If you're on isolated, you do not really need to add margin because you are risking just the 10% of your trade. All right, you are risking just that 10%, so you don't necessarily need to add margin. All right, I'll tell you when you need to add margin. That would be on the cross mode. Okay, so you're on isolated right now and the trade is running. You can see you have your risk. Your risk is what, 5.04%, and your size of USDT is 24.6000. Your entry price is here. Look at your entry price. This is your size of USDT. Watch my mouse. Entry price is here. Size of USDT. You have your mark price. You also have your liquidation price. Now, this is very important, your liquidation price. Should the price get to 0.41484, which is this right here, watch my mouse. This is a clear sign that you will be what? Liquidated. Your entire amount you are using will what? Be wiped off. That 10% of your margin, okay, will be wiped off. All right, which is $5. It's going to be wiped off. So you see we're already in profit. It's going to be wiped off completely. All right, so what do you do as a smart person? Always ensure that your stop loss comes before your liquidation price. All right, always ensure that your what? Stop loss comes before your liquidation price. All right, good. Now let's go back to open orders and see what the kind of orders we ignited. We ignited a take profit and of course a stop loss. You can see it right here. Take profit is at 0.52000 and stop loss is at 0.49000. So you see your stop loss is going to come before your liquidation if the price goes down. See it here, 0.49000. Stop loss will come right before your liquidation because your liquidation price is here, 0.41484. All right, good. And this trade, I did not analyze this trade and it's actually going well. It's going into profit already. So imagine if we actually use some good amounts to go into this trade. So the next thing I want to do, I'm going to close this right now. I'll close this right now and then we'll do the same for the cross margin mode. We're on isolated here, don't forget. See it here, isolated. So we'll do the same for cross margin mode on a buy signal, and then we'll do it on market order so that we'll just buy and see how cross margin works. Let's go, guys. Click on cancel, which is close all, and then boom. Now you can see we actually made some profits, and you can see the profit right here, 50.11 USDT. You can see it, right? Beautiful. The amount we started with before was 50.00 USDT, and we've made about 11 cents right now. So that is just how futures works. So now let's click on cross. Let's click on cross. I will click on confirm. Let's click on confirm, and then let's enter a signal with the same 10% of what our portfolio. 10% of our portfolio, this same what Matic USDT. So we're just going to click on take profit, which is 0.5200. Stop loss should be 0.4900, and then we click on buy long. Now you are going to notice something. Now you're going to notice some difference. All right, you can see right here the positions and everything is just moving smoothly. All right, beautiful. Now basically this is the cross margin mode. All right, so if you want to adjust your margin, you want to add margin, now this is how you do it. Okay, I told you before I was going to teach you how to do that, but before then, let's just see how the cross works. Now for the cross margin mode, this particular asset now will be tied, this particular margin will service different trades like I explained before. This particular margin, which we have as $50 in our account, will service different trades. Now let's go back again. Let's take another pair. Let's just take a random pair, 1 inch USDT. Let's go for this. Now we're on cross. Let's put this at 5x. All right, so I'm just showing you so you see. Now let's take a position at market price. Let's put the TP at 0. Let's say 0.6300, and let's put the stop loss at 0.6000. All right, and we're still using just 10% of our portfolio, which is 10% of $45, which will now be $4.5. Let's use 10%, and then we just click on buy long. Remember, we're on cross. Good. So just to show you what this is, you can see now we're using 4.5 here and we're using 5% here. Look at it, margin, we're using 4.5, we're using 4.9, which is about $5. And now the margin which we have was $50. So that margin is going to what service the risk of all these trades. That's why it's called cross. It's going to service the risk of what all these trades. And $50, of course, will be too small to do that. Okay, it may be too small when all the assets are, going against you. So that is why most people go into liquidation very, very easily. So as a smart person, what should you do? Very clear and simple. Always use a large margin with a small leverage if you are going on cross. Use a large margin and use a very small leverage and a position size to enter your trades, and you end up, being on the safer side. So in a case of when a trade is going against you, you can come here and just click on this and add margin to your what trade. All right, it's very simple because you're on what you're on cross. You can just add margin. How much do you want to add? 40. If you want to add 40 to this, clear and simple. You can just click on what confirm. You want to add margin, but we're not adding margin right now. We'll let this trade just run. You can see we're already in profit. We'll let this trade just run. So basically, this is how you go into a trade on futures trading when you want to buy. All right, it's that simple. The reason why you add margin is to ensure that your risk is what reduced. All right, so we'll close this right now and do the same for the sell signal. We're on buy right now. We know in futures you can make money either by buying or by selling. So I'm just going to click on close all. Click on close all, and then boom. You can see right here, I've closed all these trades. So now let's do the same for a sell signal, and I will explain that in details right about now. Let's go. Now, guys, for a sell signal, we'll actually be making profit not when the price goes up, but when the price comes down. In other words, if the price is dumping or dipping, you are making profit. That is why futures is so interesting. So what do? You just simply come here. This is 1 inch USDT. You just come here, click on sell, and then if it's cross you want to go on with, or if it's isolated, just like we did previously for the buy signal, which is the long. If you want to do that, you just simply come here, click on sell, go over to market or limit, just the way you already understand it, and um put in the take profit. Now the take profit here is going to be lower than the market price because the price is dumping. The price is going down. So if the current market price is 0.6253, your take profit should be lower, because you are saying if the price goes down, you want to what? Make profit. You are selling. So current market price is 0.6250. Look at it right here. Watch my mouse. So your take profit can actually be something like 0.600, and now your stop loss, which is higher, because you are saying if the price goes up, you start losing money. So your stop loss can now be, let's say 0.6400, and then we'll just say 10% of our portfolio on cross margin mode, and then you click on what? Sell short, and boom, you're already on your what position, because we're on market price right now. So you can see right here, it's just the same, it's similar, and you can see it's very, very straightforward. You don't even need to stress yourself, because you're on a trade currently. All right, it's very easy and it's very simple. When a trade is placed on market price, you see here your open orders will come, which is your take profit and your stop loss. All right, if the price gets to take profit, it will what? Take the profit and secure it for you. The price hits your stop loss, that trade will be closed, and you just walk away with your little losses and keep it moving. All right, so the next thing I want to talk about now is risk management. All right, risk management is very important because it entails a lot of things that people do not really understand. Okay, risk management is very, very important. Is the most essential part of futures trading, because without risk management you cannot be profitable in the long term. All right. Now, the very first thing I want to let you know is that leverage itself, which is this 5x, 10x, 20x, and all of that that you see, is not an avenue to make more money. Rather, it's a debt that you are incurring. So don't think that you can have $10 in your account and start using 20x to trade. You just burn yourself out unnecessarily and you will liquidate yourself very quickly because your margin is small. So why do you think you can go and borrow money from the bank? You don't have a collateral and you think they will give you a low interest rate. Why do you think so? Are you using what do you call it now? Are you using juju or charm or something or voodoo? It won't work. This is trading. Okay, it's the same principle that works in the real life banking system that works out here because we're talking about interest, we're talking about risk, we're talking about leverage, we're talking about debt and all of that. So as a smart person, what do? You simply, exclusively use a small leverage if you have a low capital or you have a low margin. Use a low leverage so you don't burn yourself out. But if you have a high margin, you can enter the position of that trade with a small amount and use a high leverage. It doesn't matter. Let's say, for example, you have $1,000 in your trading account. You can use $2 to enter that trade with 50x. Are you getting the logic now? So when you multiply your leverage by your position size, it will now be 50 times 2, which is $100. But in the real sense, you have $1,000 as your margin. So you see that it's actually very, very profitable and it's very simple to actually understand risk management. That is the fundamentals of risk management. So when you have a large margin, you use a small position size and a large leverage, it doesn't really matter. At the end of the day, you're still profitable and your margin will be able to cover up for your risk. All right. So basically, that is the way you should trade. Now, for a beginner, I would advise you start with isolated because you may not really understand what cross margin is and how it works. Okay. I would advise you start with isolated so that you know if you are entering a trade with $10, worst case scenario, you will lose that $10. But on cross margin mode is different because you may lose your entire portfolio in a case of liquidation if you do not have a stop loss and if you are having multiple positions opened. You have like 5 positions, you are using cross. Let's say you are into a signal group and they drop 5 signals and you enter all the signals at once and your margin is small, you will get liquidated easily. All right, so don't trade like that. Be professional, trade bit by bit, you will definitely get there. Binance will always be here, okay, but your portfolio may not always be there. So don't lose your portfolio trying to chase Binance. All right. So guys, we've actually come to the end of this futures trading section for beginners. Ensure you watch this video over and over again so that you can have a basic understanding of what trading on futures practically looks like. All right. For more mentorship and advanced training, you can send me a DM. The link is in the description of this video. We give signals, top-notch signals that can help you scale up your portfolio from A to Z, from 1 to 100, and it's at an affordable price. You can actually afford it. It's not expensive. So do send out a DM to us through the link in the description of this video. Peace out. Cheers once again, and ensure you chase your dreams. Chase your dreams as far as you can. All right. Chase your dreams. Ensure you study. Ensure you do more research. Ensure you're making money while doing this because that's the end result of knowledge. You should make money with your knowledge. Peace out. I love you all so, so much. Thanks for subscribing to this channel. And I'm going to see you all soon in the next video. Cheers, guys. One love.